Hi, I'm Pattu from freefincal. Today let's talk about dividend stocks and if the change in the tax rule for these dividend stocks or for stock dividends and mutual fund dividends from this financial year requires a change in stock buying strategy. That is, should you specifically stop buying stocks that offer too much dividends and so on. Before I do that, I want to just point out that yesterday I talked about how to invest to get a 1 lakh a month pension. I'll make a video on this tomorrow. I wanted to first do this in Tamil and then do it in English, if that's all right. And then I had also posted in the last couple of days the PPF interest rate history from 1968 to the present, and also I had released this month's momentum and low volatility stock screener for September 2020. So you can go to freefincal.com to access it. So I have made some changes to freefincal. I have shifted it to another server. In case you get into any kind of trouble accessing the site, please let me know. This is a much more faster server. I should be able to get things loaded faster. I hope. Let's hope so. All right. So coming back to this, so should I stop buying dividend stocks since dividends are now taxable? So dividends were taxed at source via dividend distribution tax, and that dividend distribution tax has been abolished from this budget, that is the February 2020 budget. So it comes into force from the 1st of April 2020, that is from this financial year, and the DDT rate was an effective rate of 20.35%. So the companies, before giving it to the stockholder, they will deduct this 20.35%, give it to the government, and then only give it. So now they will not be deducting it. So the in hand before tax dividend for the stock investor would now be higher. Of course, there's no way to compare it because we don't know what the dividend rate will be different from quarter to quarter and so on. So anyway, in effectively it's higher, but you have to pay tax as per slab on that. So for those who have not done the taxable slab, this is a great thing, because they don't have to pay any tax at all. But then they won't have much of a dividend because if your taxable, if your income is below the taxable limit, then you're not really going to have too much of stocks in your portfolio, or too much of any kind of investment for that matter. So, and those in the 5% slab would pay 5.2% and 20.8% in the 20% slab and 31.2% in the highest tax slab. So effectively, the only people who have to worry about paying tax on dividends are those in the highest tax slab. The rest of them is not much of a change. There's actually lesser effective tax, and anyway they're because of their lower income slab, the dividend income, it's also is going to be relatively lower, so it's not much of a concern. So it's going to be a problem only for those in the highest tax slab who have to pay almost 11% extra tax on the stock dividends. So the question is only applicable for them. And I have also been accumulating dividend stocks, not per se dividend stocks, the stocks that grow as well as distribute some dividend, for example HUL and so on. I have talked about my stock portfolio in a separate video. I talked about it in my audit. I've been accumulating it gradually, so it's been increasing slowly this year. I've brought it almost up to 10% of my equity mutual fund portfolio. I think my aim is to make it higher and slowly build myself a dividend income stream. And I thought about this new rule for quite a while, whether to stop accumulating stocks or what to do about it and so on. But then I decided I don't care. I love that idea of a dividend hitting the bank account, and it's just another 10% extra tax which you go ahead and paid. And I decided to go on and carry on accumulating it. The reason for that is that dividends are a wonderful way to reduce risk from an instrument. Suppose you are a private equity investor and you have put in some 1 or 2 lakhs into a company, and the company after a few years is giving you profit, and the board is going to decide what to do with this profit. 100% is it going to be reinvested, or some of it is going to go as dividend? as an investor, and you are only an investor in the company, as an investor, you would want some money now. You would want immediate benefit, immediate payout for your investment. That's what a dividend is, because you are not going to sit and do the business. You are not controlling the business. You don't have that much control on what the business will do, and there are unknown factors. Tomorrow a lot of the demand can go down because of pandemic kind of situation like this. So instead of that, if you get the payout immediately, at least some of the payout, then you have got immediate return on your investment, and that is what a dividend is. Many people have this wrong impression that growth stocks are better than dividend stocks because the returns are higher and so on. That is not true, because it's difficult for a person to calculate actual return, taking into account all the dividends, stock splits, etc., all kind of corporate actions. Many people have this kind of wrong impression about dividends. Of course, when you are young, that income should be reinvested, but that doesn't mean that income itself is bad. You have to make sure you reinvest it. But for somebody in my age who's kind of middle-aged, going closer to 50, and I'm not yet 50, but I'm closer to 50 than 40. So for somebody in my age who wants to build an income stream, this makes no, there's no issue at all doing this. Or gradually over a period of time, your income is going to increase, and there's no problem at all. For seasoned investors like PV Subramaniam and so on, who's been investing before the Sensex came into place, they even 10 years ago or 15 years ago, their dividend income would be close to their expenses. So that's my aim. I've talked about it earlier, but that's going to take some time for me. I have to pay a little tax on it. That's fine. It's not a big deal, because it's going to that's my need. If your need is something else, then you have to change your strategy. And as far as I'm concerned, dividends are welcome, and in general they reduce the risk from a equity investment. That of course it has to be reinvested if you are going to opt for it. In any case, you don't have a choice. If tomorrow a growth stock decides to change its dividend policy and start giving you dividends, you don't have a choice. You have to accept the dividend, because it's not like mutual funds where you have a choice. You can go to growth option. That's not possible here. If it stocks issues the dividend, you don't have a choice. You have to take it. And you can see the power of dividends. For example, if you take the share price of ITC over the past 5 years, it's been flat. It's been moving up and down. It's got nowhere. But 12.6% of one share, if you purchased one share 5 years ago, 12.6% of that one share price has been distributed as dividend over this period of time. HUL also has distributed 12.8% of one share price purchased 5 years ago. Of course, the stock price has also moved in the case of HUL about 156%. It's an absolute gain. And in that case, it makes, you have higher valuation also in your portfolio, but the dividends are also there. So you can't just judge a stock looking at its share price and say, oh, that's not a good stock. You have to look at the dividends as well. Of course, you can say there's hindsight bias in it, but this is not if you had purchased one stock of Wipro when it was an IPO, that it is not that kind of story. Because 5 years ago also, if you asked anybody, they will tell you HUL and ITC were good companies. So nothing much has changed over the years, and there's not much of a hindsight bias in this, in my opinion. So that's about that, and I think those who are looking to build an income stream of dividends should not change their strategy. For those who want to build wealth from stocks and they don't want too much of dividends, then probably they should go over to growth stocks or mutual funds and so on. In my case, if you notice, I've been investing in mutual funds for 10 years, and only then I started venturing into stock, because I now have that maturity. I now understand this volatility a lot better. I'm not saying that's what you should do, but that worked for me. Where after more or less my goal planning is in place, I'm going after dividends. So that's about that, and I'll catch you later. Bye bye.